Welcome to our deep dive today, where we're going to try to really untangle and get a firm grip on something that's, well, it's kind of essential if you're dealing with finances in India. That's tax deduction at source, or as everyone calls it, PDS. And we've got a pretty hefty stack of materials here, all rooted in the Indian Income Tax Act of 1961. But our aim for you is actually pretty straightforward. We want you to walk away feeling like you really get TDS, like it's not this big mystery anymore.
Exactly. We're going to break it all down piece by piece. We'll cover who's actually legally obligated to deduct tax, what all those responsibilities entail, how TDS plays out with your salary and other kinds of payments, what you can legitimately do to, maybe lighten that TDS burden a bit, the very specific rules for how that deducted tax gets deposited, what can go wrong, and what those penalties might be if you don't comply. And of course, we can't forget the role of your PAN and TAN and those TDS certificates you should be getting.
Okay, so let's jump right in and tackle the very first big question. Who is it that actually has to deduct this tax in the first place? Our sources are pretty crystal clear. The responsibility falls on the person responsible for paying, or PRP, which is laid out in detail in Section 204 of the Income Tax Act. And this is really fundamental because it tells us right away who's carrying the legal weight here.
Absolutely. That's the key starting point. The PRP is almost always the one making the payment, not the one receiving it. And Section 204 gets really specific about this across all sorts of scenarios. So let's start with a common one, salary payments. If your salary comes from, let's say, the central government or a state government, the PRP is going to be your designated DDO. That's the drawing and dispersing officer, or whoever else is specifically handling those payments. It's all about accountability within that government structure.
Makes sense, a designated person handling those government paychecks. What if you're working for a company, in the private sector?
Then the company itself is the one legally obligated. But there's a catch that this also includes the principal officer of that company. And principal officer isn't just a general term. It's very specifically defined in Section 235 of the Act. It's a wider net than just the CEO or top executives. We're talking key managerial figures like the secretary, the treasurer, a manager, even a managing director. And get this, it can also be anyone involved in the management that the tax authorities decide to specifically serve notice to. So it's not always just the top brass. It can go broader than that.
So it might not just be the CEO who's on the hook. Interesting.
Okay.
What about smaller setups like partnership firms or someone's a sole proprietor?
Well, if it's a firm, no matter what kind of partnership, the PRP is the firm itself, and that liability extends to the partners individually. For an individual, it's straightforward, they're the PRP. For a Hindu undivided family, it's the Karta. And if you're talking about any other kind of association or body of individuals, then the association or body is the PRP. And again, that can include the principal officer, secretary, or treasurer. So the law is designed to really pinpoint who's responsible right at the source of the payment, no matter what structure we're talking about.
Right. Clear accountability no matter what. Okay, so our sources also lay out who the PRP is for other kinds of income, not just salary. Can we run through some of those to get the full picture?
Of course. If we're talking about interest earned on securities, and that's covered under Section 193, the PRP is simply whoever's paying that interest. For dividends, which falls under Section 194, it's the principal officer of the company that's distributing those dividends. When it comes to other types of interests, like the interest you might earn on a fixed deposit, that's Section 194A, and again, the payer is the PRP. This one applies broadly individuals, HUFs, companies, firms, you name it, subject to the specific conditions in that section. You'll notice a trend here, right? The responsibility is generally on whoever's making the payment.
Yeah, it seems like that payer-centric approach is pretty consistent. So what happens when we're talking about payments for services? Someone's done some work or completed a contract.
If we look at payments to contractors or subcontractors, which is dealt with under Section 194C, the legislation gets very specific about which payers are considered the PRP. So we're talking about the central government, state government, any local authority, a company, a firm, a trust, a cooperative society, and even individuals or HUFs whose accounts need to be audited under the Income Tax Act. So it's not just big corporations, even some individuals can be responsible. That audit trigger for individuals and HUFs is really important to keep in mind.
Got it. What about rent payments? Who's responsible there?
For rent, which is covered under Section 194I, it's the person paying the rent who's the PRP. But, and this is a big but, individuals or HUFs who don't need to get their accounts audited, they generally don't have to deduct TDS on rent. That's a bit of relief for, say, smaller individual landlords.
That's helpful, especially for individuals.
Yeah.
And what about people who provide professional or technical services? They're getting paid for their expertise.
So fees for professional or technical services, that's Section 194J. And like Section 194C, we're talking about specified payers being the PRP. The Act lays out who those specified payers are, generally larger entities, and those who have to be audited.
And finally, payments that go across international borders. What's the TDS rule there?
Payments to non-residents. That's Section 195, and here the PRP definition is quite broad. It's basically anyone who's paying a sum that's taxable in India to a non-resident. This is where the payer needs to be extra careful in figuring out if the income is actually taxable in India for the non-resident.
So figuring out who the person responsible for paying is, well, that's clearly step one. But once you figure that out, what are the actual duties, the things you're legally required to do as the PRP? Our sources have a pretty long list.
They do, indeed. Once you're the PRP, you've got a whole set of crucial duties. First and foremost, you have to get yourself a TAN. That's your tax deduction and collection account number. It's a 10-digit unique identifier, and pretty much every deductor needs one. Now, there are a few very specific exceptions, like if you're deducting under Section 194IA, which deals with immovable property, or 194IB, that's about RET payments by certain individuals and HUFs, or 194M, which covers certain payments for things like commission, brokerage, and professional fees. In those very specific cases, your PAN might be enough. But for the vast majority of TDS situations, getting a TAN isn't optional, it's the law. And you have to quote this TAN everywhere on those payment challenges when you deposit the tax, on the certificates you issue, and on the returns you file with the government.
Got it. So the TAN is basically your ID card in the world of TDS. What's the next big responsibility on the PRP's plate?
The next big one is actually deducting the tax. And you have to do it at the right rates. The timing is crucial here. The law says you deduct tax at the earlier of two events, either when you credit the income to the receiver's account or when you actually make the payment, cash, check, draft, whatever. Whichever comes first is when you deduct. And obviously, this deduction has to be at the rates laid out by the Income Tax Act or any finance act that's in effect that year.
That earlier of rule, yeah, that seems important to avoid delays. Now, when we're specifically talking about salary, are there any special things to keep in mind?
With salary under Section 192, it's a bit more involved for the employer, who's the PRP in this case. They can't just deduct a fixed rate. They have to consider any exemptions and deductions that the employee might be eligible for. So this usually starts with the employee giving the employer a declaration, typically in Form 12BB. That's where the employee lists out things like their investments and expenses that qualify for deductions under Chapter PPF, insurance premiums, housing loan repayments, and they also declare any exemptions they're claiming, like HRA or LTA. Based on that declaration and any proof they need to back it up, the employer then figures out what the employee's total income is likely to be for the whole year. Then they calculate the total tax on that projected income, and from there, they figure out how much to deduct each month from the salary for the rest of the year.
So the employee really needs to give their employer all the right info. What happens if they don't, for whatever reason?
That brings us to the next crucial duty, verifying the PAN of whoever you're paying. The deductor, they're legally required to get a valid PAN from the person or entity they're paying. If that person either doesn't give their PAN or gives one that's wrong or doesn't match the records, then the deductor has to follow Section 206 Bella A, which means deducting at a much higher rate. This higher rate is usually 20%, or whichever is higher, between 20% and the rate for that specific payment under the Act or Finance Act. Basically, this provision makes sure people are incentivized to give their correct PAN.
Yeah, sudden jump to 20% deduction, that's definitely motivation to give the right PAN. Okay, so after the deduction happens, what's the next step?
The next big step is depositing that deducted TDS amount directly to the central government. And this has to happen within very specific deadlines set by the Income Tax Department. The right challenge form has to be used, which is usually ITNS 281. We'll get into those specific deadlines and how you can deposit the money a bit later, but what's important is this. Depositing the deducted tax isn't just a formality, it's a legal requirement.
All right, so we've got the deduction itself and then the deposit to the government.
Yeah.
What's next in terms of paperwork or filing?
After the deposit, the deductor has to file their TDS statements, or returns as they're called. These are filed electronically, and they have to be done in a certain format. Like for salaries, it's Form 24Q. For other payments to residents, it's Form 26Q. And for non-residents, it's Form 27Q. These returns basically give the government a detailed record of every TDS transaction in a given quarter, and they have to be filed electronically by specific due dates.
And these returns are what let the government keep track and make sure the person who had the tax deducted actually gets credit for it. So what's the actual proof that the person who had the tax deducted receives?
That proof comes in the form of TDS certificates. The deductor is required to give these certificates to the deductee, the person they deducted the tax from, within certain deadlines. If it's for salary, it's Form 16, and the employer gives it to the employee annually. For other types of income, it's Form 16A, which is usually issued quarterly. These certificates have the important details: how much income was paid, how much tax was deducted, and confirmation that it's been deposited with the government.
So the person who had the tax deducted has that certificate as proof, which they'll need for their own tax filing. What are some other responsibilities of the deductor, maybe things that aren't so obvious?
You're right, there are other things to keep in mind. They have to keep good records of everything the tax deducted, the deposit dates, copies of those certificates they issued. They also have to respond to any notices or communication they get from the income tax department about TDS. And if they make any mistakes in those statements or returns they filed, they have to file correction statements to fix those mistakes and keep everything accurate.
Seems like a lot to handle. What are the consequences if these duties aren't handled properly?
If you don't do these things properly, there can be some pretty serious consequences. You could be liable for interest on any late deposits. You might have to pay fees for filing returns late. You could be penalized for not deducting the tax in the first place or for not depositing it. And in really serious cases where it's intentional, there's even the risk of being prosecuted under the Income Tax Act. So following these TDS obligations isn't just good practice, it's legally crucial, and there are real financial and legal risks if you ignore them.
Makes sense. Earlier, we touched on Section 204 when we were talking about who the person responsible for paying is. Our materials really emphasize this section. Why is it so important for the whole TDS system?
Section 204 is really the foundation of the whole tax deduction at source system. As we talked about earlier, it very clearly spells out who the person responsible for paying is for TDS, as per Chapter 7B of the Income Tax Act. The whole point of this section is to remove any doubt about who's accountable for TDS, and that accountability is tied to the type of payment and who's making it. Without Section 204, the entire TDS system would be a mess. People could easily avoid their obligations, and the tax authorities would have a really hard time enforcing it.
So it's all about being absolutely clear who's on the hook for making sure TDS happens for every single payment that's supposed to be taxed this way. Can we revisit some of the key situations covered by Section 204 just to really drive home how broad it is?
Sure. So for salaries paid by the government, whether central or state, the DDO, or the head of that government office or department, they're responsible. For salaries paid by private companies, it's the company and the principal officer who are both responsible. And remember, principal officer has that broad definition we talked about, could be various people within the company.
That double responsibility for companies, naming both the company and a specific person, that really emphasizes how seriously the Act takes this, right?
Exactly. When it comes to interest on securities issued by the government or a local authority, the officer responsible for making the payment, they're the PRP. If it's a company issuing those securities, it's the company and, you guessed it, the principal officer who are responsible for TDS. Dividends follow the same pattern: the company giving out the dividends and their principal officer, they have to ensure TDS compliance.
What about other payments made by the government, not just salaries?
For any other payment from the central or state government, the Act specifically says it's the designated officer who's responsible for making that payment. So even in a big government structure, there's always someone clearly accountable for TDS.
And for all the other financial transactions that don't involve the government?
For pretty much every other payment, whether it's an individual, an HUF, a firm, an AOP, whatever, the Act just says the payer is the PRP. And as always, if it's a company making the payment, both the company and the principal officer are responsible. So Section 204 is really designed to cover every possible situation, making sure that no taxable payment slips through the cracks.
So understanding Section 204 and who you are in that context, that's clearly step one. But what are the actual legal things you have to do? What are the consequences if you're named the PRP?
Being the person responsible for paying under Section 204, that triggers a whole bunch of legal obligations. As we've talked about, you have to deduct the right amount of tax, deposit it with the government on time, file those TDS statements or returns electronically, and issue those TDS certificates.
And the law doesn't mess around if you don't do these things, right?
No, it doesn't. You also have to follow all the procedures, like getting your TAN and quoting it everywhere and making sure you have the PAN of everyone you're paying. If you don't do these things, you can be considered an assessee in default under Section 201, which means you could be held liable for the tax, the interest, penalties, and even face prosecution. So knowing about Section 204 isn't just about a definition, it's about understanding the serious responsibilities that come with it.
It's all very clear now why Section 204 is so important. Let's shift gears and focus on salary income, something a lot of people are familiar with. Our materials go into detail about how TDS works for salaries under Section 192 of the Act. What are the most important things we need to understand here?
Well, Section 192 is the section that deals specifically with TDS on salaries. It's the employer's responsibility to deduct income tax from their employees' salaries when they pay them. It's not a choice, it's the law.
And it's not just about deducting a flat percentage, right? Employers have to consider all sorts of things that could affect an employee's tax liability.
You got it. They have to estimate the employee's total salary income for the whole financial year. That means considering everything: basic pay, allowances, any perks or benefits, bonuses, the whole package. To get a more accurate picture, the employee usually gives the employer a declaration, usually in Form 12BB. In this form, the employee tells the employer about any investments or expenses they have that can lower their tax burden. Things covered under Chapter 6A, like investing in a PPF, paying insurance premiums, or repaying a housing loan. They also tell the employer about any exemptions they're claiming, like HRA or LTA.
So the employee plays a big role by giving the employer all the necessary information. What does the employer do with this information and any proof the employee provides?
The employer has to look at all this information, the declaration, the proofs, and consider those deductions and exemptions when figuring out the employee's taxable income for the year. Basically, they apply the rules and limits for each deduction and exemption, making sure everything follows the Income Tax Act.
Okay, so after the employer has figured out the employee's taxable income, how do they figure out how much tax to actually deduct from each paycheck?
They take that estimated taxable income for the whole year and calculate the total income tax liability on it. To do that, they use the tax rates that are in effect for that year. And very importantly, they also need to know whether the employee has chosen the old tax regime or the new one, because that can make a big difference.
So an employee's choice of tax regime can really change how much TDS they have to pay.
Absolutely. The tax rates and what you can deduct or exempt are very different between the old and new regimes. So the employer needs to know which one the employee has chosen. Once they have the total tax liability figured out, they divide it by the number of months the employee is expected to work that year. That gives them the average monthly TDS amount to deduct.
That explains those regular monthly deductions we see on our salary slips. What if someone works for more than one employer during the year? How does TDS work then?
When an employee has multiple employers in the same year, it's their responsibility to give their current employer all the details about their previous salaries and how much TDS was deducted. They usually do this using Form 12B. This helps the current employer get a complete picture and adjust the TDS accordingly, so the employee doesn't end up paying too much or too little tax by the end of the year.
Makes sense, to keep things accurate. Are there any other special situations the employer needs to consider when figuring out TDS on salary?
There are a couple more things. If the employee has a loss from house property, maybe because of interest they're paying on a home loan, they can declare this loss to their employer. The employer can then consider this loss, up to the limit allowed by the Act, and reduce the employee's taxable income, which would lower the TDS. Employees can also tell their employer about any income they have from other sources, like interest or rent. The employer might not always have to deduct TDS on this other income, but knowing about it can help them get the overall tax calculation right, especially if the employee expects to have a higher total tax liability for the year. And one more thing. If the employee can claim relief under Section 89, for example, if they get arrears or advanced salary in the current year that relates to past years, the employer needs to consider this when figuring out the TDS to avoid deducting too much tax in that year.
Seems like there's a lot involved in getting the TDS on salary right. Our materials actually give a step-by-step process for this whole calculation under Section 192. Can we go through that step-by-step so we really understand how everything comes together?
Sure. The first thing is figuring out the employee's gross salary for the year. That includes everything they're getting that's taxable. From this, the employer subtracts any exempt allowances that the employee is eligible for, like HRA and LTA, which have their own rules and calculations. Once they've subtracted those exempt allowances, what's left is the gross taxable salary for the year.
So gross taxable salary is what's left after you remove those specific exemptions. What's next?
The next step is deducting specific things allowed under Section 16. There's the standard deduction, which is 50,000 for everyone, regardless of which tax regime they've chosen. Then there's entertainment allowance, which is only for government employees. And lastly, they deduct any professional tax that the employee has actually paid during the year. After subtracting all that from the gross taxable salary, we get what's called the income chargeable under the head salaries.
So that's essentially their core taxable income from their salary. What else needs to be factored in?
If the employee has told their employer about any other income they have, like interest or rent, that gets added to the income chargeable under salaries. And if they have a loss from house property, that gets subtracted, but only up to the limit the Act allows. Once you've made these additions and subtractions, you have their gross total income, or GTI, for the year.
We're getting close to the final taxable amount now. What comes after figuring out the gross total income?
Now, if the employee has decided to stick with the old tax regime and they've given their employer proof of their investments and expenses, the employer then deducts any amounts that qualify for deduction under Chapter CIA of the Act. This chapter covers a lot of the popular ways to save on taxes, things like deductions under Section 80C for investments like PPF and ELSS, Section 80D for medical insurance, Section 80E for interest on education loans, Section 80G for donations, and Sections 80TTA and 80TTB for interest on savings accounts. But it's very important to remember that most of these deductions under Chapter VA aren't available if the employee has chosen the new tax regime. That's a big difference between the two.
Definitely a key difference for employees to consider. So you subtract those Chapter Psych EA deductions, if applicable, and what do you get?
That gives you the total taxable income for the year, sometimes also called the net taxable income. This is the final amount on which you calculate the actual income tax.
And how do you actually calculate the income tax on this amount?
The employer uses the income tax slab rates for that year. And remember, the rates will be different depending on whether the employee is using the old regime or the new regime. Once they have the initial tax amount, the employee might be eligible for a rebate under Section 87A. This rebate applies to taxpayers whose total income is below a certain limit, and it can reduce the total tax payable. Right now, that limit is 5 lakhs for the old regime and 7 lakhs for the new regime. If your income is below those limits, you don't have to pay any tax.
That's a big relief for people with lower incomes. What happens after the rebate is applied, if any?
After the rebate, if any, you have the tax payable after rebate. If the employee's income is above certain limits set by the government, they might also have to pay a surcharge, which is an extra amount calculated as a percentage of the tax. If there's a surcharge, it gets added to the tax payable after rebate, giving you the tax and surcharge payable. On top of that, there's a health and education cess, which is 4% of the total tax and surcharge. Add that, and you have the employee's total tax liability for the year.
We're almost there. Are there any last adjustments to be made to that total tax liability?
If the employee has claimed relief under Section 89 because they got arrears or advanced salary this year that relates to previous years, then the employer subtracts that amount from the total tax liability. That gives us the final net tax payable for the year. Then, to get the monthly TDS amount, they divide that total by the number of months the employee is expected to work that year.
That's a very detailed explanation, thanks. Now, what if someone thinks their total tax liability for the year is going to be much lower than what's being deducted from their income at the normal rates? Can they do anything about that? You mentioned applying for tax deduction at lower rates. How does that work?
Yes, you're right. The Income Tax Act has standard rates for TDS, but it also understands that sometimes someone's total tax for the year will be less than what those rates would deduct. To avoid deducting too much tax, Section 197 allows people to get a certificate from the tax authorities to deduct tax at a lower rate, or even no tax at all. This helps make sure the TDS is closer to what the person actually owes in taxes.
So you can ask for your TDS to be adjusted to better match your actual tax situation. Who can apply for this, and for what types of income does this apply?
It's the person receiving the income, the deductee, who applies to their local assessing officer for this certificate. They can technically apply for this for salary income too under Section 192, but it's not very common. Usually for salary, any adjustments are handled through those deductions and exemptions we talked about. However, Section 197 is used a lot for other types of income where TDS is deducted. This includes interest on securities, Section 193, dividends, Section 194, other kinds of interest, Section 194, payments to contractors, Section 194C, insurance cushions, Section 194D, commission or brokerage income, Section 194H, rent, Section 194I, professional fees, Section 194J, and even payments to non-residents, Section 195. There's a long list of sections where this applies.
So it's a pretty broad provision. What do you actually have to do to apply for this lower TDS certificate?
You apply online using form number 13, and you need to give a good reason why you should be taxed at a lower rate or no rate at all. You usually have to give a detailed calculation of your estimated income for the whole year. This calculation should show that the normal TDS rates would deduct more tax than you'll actually owe for the year. You have to give all the details of your income from different sources, the deductions you think you can claim, and how much tax you estimate you'll have to pay.
So you're making a case to the tax authorities to justify the lower TDS. What happens next?
After you submit your application with all the details and proof, the assessing officer checks everything. They'll look at your income, your estimated tax liability, and any tax you've already paid through advance tax or self-assessment tax. If they agree with you, they'll issue a certificate electronically. This certificate will have your name and PAN, the name and TAN of whoever is deducting the tax, the specific sections of the Income Tax Act that are involved, the lower rate they're allowing, how long the certificate is valid for, usually the rest of the financial year, and sometimes a limit on how much the lower rate applies to.
So the certificate is specific to who's paying you and for a specific time period. What do you do once you get the certificate?
You give a copy of the certificate to everyone who's deducting tax from your income, the people listed on the certificate. Then they're required to deduct tax at the lower rate or no tax at all as per the certificate. And when they file their TDS return, they need to quote the certificate number so the government knows about the lower deduction.
How long is the certificate valid for? Is it a one-time thing?
It's usually valid for the rest of the financial year, and it's generally specific to the people or organizations named on it. If your financial situation changes a lot, like if your income goes up a lot and you might end up owing more tax, you might need to apply for a new certificate, or the assessing officer might even cancel your current one. So it's not a permanent thing. It depends on your financial situation and the period it was issued for.
So it's there to help you avoid having too much tax deducted unnecessarily. Now, once the tax is deducted, it has to reach the government. What are the rules for depositing that deducted tax?
Once you deduct the tax, you absolutely have to deposit it directly with the central government by the deadlines the income tax department sets. And these deadlines can be different depending on who's deducting the tax. For most people and organizations, not including government offices, if the tax is deducted between April and February, you need to deposit it by the 7th of the next month. So if you deduct tax in June, it needs to be deposited by July 7th. However, there's a bit more time for tax deducted in March. You have until April 30th of the next financial year to deposit it.
A little bit more time for the March deductions. What about government offices? Do they follow different rules?
Yes, government offices have their own rules. If they pay the tax without using a physical challan, basically if it's an internal adjustment, they have to deposit it the same day they deduct it. But if they use a challan, the deadline is the same as for everyone else by the 7th of the next month.
Any exceptions to these general deadlines?
There are specific rules for some sections, like Section 194 IA for immovable property transfers, Section 194 IB for rent paid by individuals and HUFs, and Section 194M for payments like commission and professional fees by individuals and HUFs above a certain limit. For these, the deducted tax has to be deposited with a challan come statement within 30 days of the end of the month the deduction was made. So you'd have a bit longer, but there's still a deadline.
Okay, so those sections have their own procedures. How do you actually make the TDS payment to the government?
There are two ways, electronically and physically. Electronic payment, or e-payment, is mandatory for some deductors. This includes all companies, anyone who had a tax audit in the previous year under Section 44AB, and all government offices.
So e-payment is a must for a lot of people, especially larger organizations and government offices. How does it work?
You can either go to the Income Tax Department's website or the online portal of a bank authorized to collect taxes. The payment is made using Challan ITNS 281, and you can pay through net banking, credit card, or debit card. E-payment is definitely the better way to go because it's more convenient, you get confirmation right away, there are fewer chances of errors, and it's easier to match your payments with your TDS returns later.
That does sound much simpler. Can you still pay physically?
Yes, if you're not required to do e-payment. This usually means individuals and HUFs who don't need an audit under Section 44AB. You'd fill out the ITNS 281 challan by hand and submit it with your payment, either in cash or by check at certain bank branches, but it's less convenient, it can take longer for the payment to go through, and there's a higher chance of mistakes.
Whether you pay electronically or physically, what are some crucial things to make sure you do correctly?
Make sure you're using the right Challen form, which is ITNS 281, and that you quote your TAN and the PAN of whoever you deducted the tax from correctly. If you get this wrong, it can create a lot of problems for both you and the person you deducted the tax from later on.
So getting those details right is crucial for everyone. Now, if you don't handle these obligations correctly, if you don't deduct the tax or you don't deposit it on time, there can be serious consequences. What are those consequences?
The Income Tax Act is very strict about TDS. If you don't deduct or deposit the tax on time, you might have to pay interest on the late payment. Also, if the TDS on certain expenses like salaries or rent isn't deducted or deposited on time, you might not be able to claim a deduction for 30% of those expenses in your tax return. Plus, you could be considered an assessee in default, which means you're responsible for the tax, and you could face penalties and even prosecution in some cases.
Let's take a closer look at those consequences. First, what about the interest charges for late payments?
If you don't deduct the TDS on time, Section 2011A of the Income Tax Act says you have to pay interest at 1% per month on the amount you should have deducted. This interest is calculated from when you were supposed to deduct the tax until the date you actually deduct it. If you did deduct the tax but didn't deposit it on time, the interest rate is 1.5% per month, calculated from the date you deducted it until you deposit it. Remember, this interest is mandatory, and the Income Tax Department doesn't need to tell.